Welcome, everyone. My name is John Mazzara, Remax Results. This is my channel, and I have my good friend Sean Swanson with CMG Home Loans. And he is going to tell us all about a new product. Well, maybe not new to him, new to me, because he just shared it with me. And I had to get him on the channel so he could share it with you about one of his investment property loans called debt service coverage ratio loans. But his is a little different than you may have heard from other lenders. And he's got other stuff he wants to share too. So I'm going to go ahead and let Sean share his screen and take it over. Sean, introduce yourself, please, and then share lots of good wisdom and information with us.
Yeah. Hey, everyone. My name's Sean. I am a loan officer, and I do loans in all 50 states. It's really nice to meet everyone. I'm glad that you are able to tune into John's channel here. Today, we're going to talk about a couple of different things, and it's a different perspective on the market and whether waiting is a good thing, bad thing, or where we really land up. And we're also going to talk about some different programs that you may not have heard of before, and maybe you have. And so we're going to go through some of that. I'm going to go ahead and share my screen and present some information. Hold on one second. All right. And let me know when I can share my screen.
You should be able to now, Sean. I didn't take it away
Okay.
here.
Let's take a look.
Yep, you should be able to share.
Perfect.
There it is.
All right. So a lot of people come to me and John, and they often ask, where's the market going? What's going to happen in the short term? And the short answer is no one really knows. And so what I did is I compiled a little bit of information just to take a snippet from, back in the early 90s, because typical mortgages are about 30 years. That's the typical length someone gets their loan is a 30-year fixed rate mortgage. And I wanted to look back and see, are home values really going up at this crazy level? And is that normal? Is that expected? Is there a crash coming? And what the data showed was really interesting is not so much that the value of houses have been increasing significantly year over year over year over year, and that it's unsustainable. We're not in this period of unsustainable growth and it's just destined to all fall apart into pieces. When I pulled the information, it was more the weakening of our dollar. And what I mean by that is I put together some items here that everyone's familiar with. Everyone's gone out to eat at some fast food restaurant. Everyone fills up their tank with gasoline and insures their car with insurance. And I looked at medium house prices. And now, while house prices vary from market to market, you can see just in general, the rent increases as well have significantly increased. Now, this is out of California, where things are a little bit more expensive, but you can see the trend carry over from state to state year after year. And the median house price has gone from, in 1991 from about 194,000 all the way up to today about 861,000. When you're seeing this dramatic increase, it's normal for people to get nervous and say, am I doing the right thing? We saw 2008. Is that going to happen again? And we do open houses and get feedback from people. And a great story that I have is this lady came in and she bought 3 houses. And one of the houses, she paid $14,000 for it. The other one, she paid about $16,000. And the third house she bought was $150,000. And she told me it was in the early 90s that she bought this and that she actually stopped buying property. And I asked her why. And she said, well, the values were just so out of control. I couldn't imagine buying any more properties. Keep in mind, she was walking into a house that was just a couple of blocks away from where she lives. And that house was being listed for $1.3 million.
Hmm.
And that just goes to show that it's not the value of the property that's going up. It's the fact that our dollars are deteriorating in terms of our purchasing ability. I have a chart here that shows a quite scary number, right? And it's really the true value of the dollar since 1990 to today. And you can see it is a straight line down. And that kind of correlates with the property values have been going up. So this is a great way of protecting yourself. When you look at a 30-year loan, you can see just the difference between where we would be from today's prices to before the loan actually even would be paid off, which is about 25 years. I just looked at it on a 25-year mark, and we're over 300% in terms of a 4% appreciation compounded. So this is to show you're not wrong by saying that the house is maybe valued at extreme measures, but it's why are they being valued at that? And it's just because there's so much dilution, which means, power being taken away from each dollar that we use and each dollar that we're given at work, that if you can make the payment and if you can find programs that can allow you to acquire these properties and assets, it's going to be something that you're going to pay off in the long run. It's going to help you build generational wealth. It's going to be able to protect you when times are good and bad. So I just wanted to share this portion with you, John, what I was presenting here, and wanted to kind of lead off with the questions that you had and continue on from there.
Yeah, no, those are great observations. I tell people that they should be buying because homes are generally appreciating, and that when the rates come down, which I believe that they will in 18 months, they'll be in a lot more competition as
I
more
agree.
buyers are entering, and then they're going to pay more. So um, they should be buying and taking advantage of some of the hesitancy that's out there today. The millennials and the Gen Zs are just getting going, and the average home buyer today is around 36, and there's more of them than the boomers. And when they decide they don't want to pay 3 to 4 thousand bucks a month rent and enter the housing market, that's going to create an intense amount of competition. And with these with these rates and with the hesitancy, we're not replicating enough homes building for the demand that will be there, which means supply and demand will be out of balance. There'll be a shortage, hypothetically, of homes, and prices should go up. So I like your chart. It was great information. If you're investing in an asset that'll participate with inflation, like real estate, then you want to get into that asset. And the cost of things typically doesn't get better; it gets worse. So you should buy when you can. And like you said about wealth, when I see it, I see people and I see where their wealth is. It's in two areas: their retirement plans, which they've saved, throughout their life, and accidentally through the appreciation of their home. And if they hadn't bought that house, they would be set up poorly for retirement. And that is what sustains many people in retirement is their equity. So they need to invest in real estate and own an asset rather than be a tenant of somebody else if they have the ability. So that's my message, and I'm sticking to it.
No, 100%. And that's one of the things that I've really enjoyed about working with you in our partnership. And one of the things that you really excel at is finding investments, right? Not every realtor is the same, and not everyone brings the same value. One thing that I've always noticed about you is being able to find investments, and that's actually what we're here to talk about today, are different ways of looking at real estate, how to acquire it, how to purchase it, how to get the money to purchase it, and how to keep yourself protected too. So, one of those loans that we're going to talk about today are the debt service coverage ratio loan. So, how this loan works is very, very simple. We're not qualifying your income, we're qualifying the property. Now, what's really, really unique about Minnesota is the fact that it has more duplexes than anywhere else in the whole entire country. Not many people realize this, and they don't really see the value in this. The rents in Minnesota, believe it or not, they rival some of the other markets in the country. And the price points are still accessible. They're not as inflated due to people moving and working remote from COVID like they are in the coasts, from the West Coast to the East Coast, whether it's Florida or California, where prices have been pushed up because people have been moving. Minnesota has a really nice blend of medium to high market rents in comparison and lower purchase prices. So, what that means is it allows you to have really good rents in comparison to the actual amount of money that the house will cost. Now, our program, the DSCR loan, fits this perfectly. It's a match made in heaven because instead of going through a normal loan process where they look at your current loan, if you have a primary house, they look at your car loans, they look at your credit card payments. Instead of doing all of that, what we do is we just look at the rents that are going to be accumulated from this property. Now, you put down 20% and you're able to acquire a property, right? So you put down 20%, they'll pull your credit, but the loan will actually not even show up on your credit report once it's finalized. This is a business purpose loan, which means you're able to acquire properties without hurting yourself from getting a car loan in the future, without making it more difficult to buy a primary residence in the future as well. Now, DSCR loans have been around for a long time, and all the way it works is do the monthly payments of the property from an appraisal. Now, an appraisal is a report that's created by someone that goes out, takes a look at the property and the houses in the area, and there's a paragraph in that appraisal. It's called a 1007. Now, it sounds a little complicated. It's not. All it is, it's a paragraph that says the market rents of these properties, whether it's a duplex or a single family house or a condo, is X amount. Now, if that dollar amount covers the monthly mortgage payment, which is the principal, interest, taxes, insurance, and if there's an HOA, that's all you need to be able to qualify for this loan. It won't show up on your credit report. You're able to title it in an LLC, which keeps you protected. So that way, if something happens at that property, it doesn't affect everything else. So that's something that's really nice. And a unique thing that we have to offer here is actually a 5 to 8 unit property. Now, most people think of residential, purchasing a house or a duplex or a 4 unit. We actually have a product that is really unique. So normally, whenever you go above 4 units, the rent doesn't need to cover 100% of the mortgage payment. It actually needs to cover 125% of that mortgage payment. And normally on these loans, they're more dangerous because usually how they're worked is they're either 3, 4, or 10-year repayment times. And then there's a balloon payment, which can be quite scary. And they're not usually 30-year fixed loans. One of the things that we do here is we do 5 to 8 unit properties, and you're able to actually do 25% down on a 5 to 8 unit property. And it goes back to the same basic rules of 1-to-1. If the payment's $2,500 and the market rent is $2,500, that's all you need to be approved for this. It's an easy process to be able to acquire properties and really be able to scale how many checks that you can get in each month, because that's all these are. The more doors, the more checks, the more opportunity to build your wealth.
Question for you, Sean. So you said 5
Yeah.
to 8, but I could do it on a 1 to 4 the same, correct?
Yeah, 1-to-4, it's just the same. It's actually a little bit easier. It's only 20% down that's needed. Something that's really unique about Minnesota is normally on these commercial loans, there's a prepayment penalty, which means when you do the loan, you can't actually refinance or pay it down to zero for 1, 2, 3, 4, or 5 years. Well, Minnesota doesn't allow for prepayment penalties, which means you can actually buy a house, be able to collect the rents that cover the mortgage, get approved for this. And if the rates come down within 1 year or 2 years or 7 months, you can actually refinance into that, where other parts of the country, they're handicapped to the option that they select when they close the loan. Whereas Minnesota is in this really unique scenario. And that's why we're on this Zoom together and doing this presentation, is because Minnesota has got this really good sweet spot. So one of them is the rents are high. Second one is the property values are not as high as other parts in the country. And third is they have additional protections. So that way, if rates come down, you can recapture those lower rates. Now, keep in mind, you don't have to worry about affordability, because that's the nature of the loan. You can only get this loan if the rents cover the mortgage, which means you can build your wealth, have tax write-offs, right? There's taxes and interest and depreciation, and then you can also get the income from it. So Minnesota's set up in a really great spot. I've seen them all over. 6-unit apartment complexes, 8-unit apartment complexes, all throughout South Minneapolis. And John, you've been in the Minnesota market for so long, and you've seen good deals, you've seen bad deals. Uh, you can guide people so well. You helped me. You helped me get my duplex. And there's one of the greatest decisions I ever made. And I remember back in 2019, we were hearing the same exact tune, right? History doesn't repeat itself, but it rhymes. And I was hearing the same thing in 2019. Ironically, there was tariff conversation. There was conversation about prices being too high, about uncertainty, and what happened, right? Prices only went up, and I'm so glad that I was able to purchase that duplex for my mom. And you were able to help navigate me through the process, understanding the neighborhoods, understanding the income, understanding the benefits of a duplex versus just a single family house. So I'm speaking by experience, and that's why I'm here, pounding my hand on the table for people to reach out to us. It does not hurt to have a conversation and see how we can get started, create a plan.
That's fantastic. Now, Sean, what is the minimum and what is the maximum loan that you can do on this product?
Yeah, so the minimum loan is going to be 150,000. So
Okay.
if we're looking at 150,000, we'd be right around 187,000 for a duplex.
Okay. Um, and that 150 translates into a payment of about any idea what that equals?
Yeah, like let's pull this up here. I will.
I'm just thinking somebody could work it backwards if they're trying to figure out what they could pull out. For example, like if I
Well, I'd kind of loft this back to you, John, and ask you, on a duplex in Minneapolis at 300,000 purchase price, what do you think the average rents would go for on something like that? Like, let's say it was a 3-2 and a 2-1.
Oh, the three is probably going to be closer to 2,000, and the two is probably going to be 16, 1,700.
Okay, so we're thinking about $3,600, right? I
Yep,
mean, rough estimate.
yep.
Okay, so through this loan, remember how it works is we just look at the loan payment, taxes and insurance versus the income. So just the loan itself would be about $1,700. And so what do you think insurance would be on a duplex like that?
It's pretty ugly these days. I'd probably say about 300 bucks a month.
Okay, so we have that plus $300 a month, and then taxes are about what, 1%?
No, we're in Tim Walls land. We're looking
Oh
at
no.
Minneapolis is going to go up by 10% this year and 10% next year. So I'd figure what 1.4 on the value of the building. So
1.4. Okay, so let's just say $4,200.
yeah.
Yeah. Ooh, John, you might need to sell my sell my duplex for me. So we would be looking at about $350 a month in taxes, right? So $300 a month in taxes plus $300 a month for insurance plus the loan. And now keep in mind, we talked about $3,600 a month in market rent, right? So the loan itself is only going to cost $2,369. You're expected to bring in $30,600. That's $1,231 a month that comes directly to you. Now, keep in mind when you get that paycheck in the mail, or direct deposit nowadays, I should say, if you get $1,231, you're actually getting probably around $738. You're getting no tax benefits. You're getting no write-offs. There's no interest that you're writing off. There's no depreciation. There's all these things that help build wealth, and you're missing out on that. Versus this, you're actually going to get $1,231 hit your checking account, allow you to save and build reserves and have money for emergencies. And more importantly, is you're going to have someone else, keep this in mind, someone else is paying for all the equity in your house.
Did you do that with 20% down, Sean, or 25?
I did that with 20% down.
5% down. Okay, cool. All right. Well, that's just one example. We can fine tune that on any property, or Sean can, for you. And what's really neat is that if you are an existing landlord and maybe you're self-employed, maybe you're retired, maybe you're over leveraged, you have 10 properties, whatever your situation is, because the property stands alone, and carries the debt, you could refinance it using a DSCR loan and then take those proceeds and buy it using that with another DSCR loan. So you can leverage and pyramid these as you continue to roll out your portfolio when you otherwise might not be financeable, if you will, through traditional outlets. So DSCR is great for that person that has an inability for whatever reason to qualify, but it can make the payment. The building's making the payment. Sean, what is the minimum credit score somebody needs for this?
Yeah, 680.
680. Okay, so that's not insurmountable for most people. I mean, you should be at a 680 for most people. So, yeah,
Yeah,
that's
and to add on to that, one thing that we do here is we have an ability to do what's called a rapid rescore. Now, what is this and why is it important? So, what a rapid rescore is it allows us to do a soft credit pull application with anyone. These applications never expire, right? So we can start a plan today, and it doesn't matter when we get there, as long as we get there, right? So the soft credit pull allows us to look at the credit, see where it's at. It's not hard, so it does not hit your credit report, but it will allow us to see what things we may be able to do to increase that credit score. Now, these things can be as simple as paying down a credit card by a very specific amount, $732. It could be something as odd as adding to a credit line. I've seen rapid rescores where people need to add $25 to their balance, send us a screenshot of that balance, and then it's recalculated. So normally, as you know, when payments apply to a credit report, there's usually a delay, right? So there's usually like a 1 or 2 month delay. We're able to do this in a matter of a week and be able to say, okay, do these items, and then you should have an opportunity to have a credit score of 740, 690, whatever. We'll be able to do that in a quick period of time and get you that information back, update the credit, and then we'll be able to move forward too. Also, whenever we're doing a DSCR loan and there's two people on a credit, two different borrowers, what's really nice is whenever you try to do this with mortgage loans, traditional mortgage loans, they always take the lower credit score. On DSCR loans, if you want to go in on an investment with your friends, with your family, with a business partner, they'll always take the person with the higher credit score, which is very unique, and it doesn't happen with any other type of loan. So it
Hmm.
allows you to use the best credit score, and it allows you to title the property itself. You can do two LLCs as ownership, which is really nice. You can have partnership agreements, so that way your items are protected. And for those homeowners that are currently out there that have that low interest rate, that say, man, John, I have all this money locked up in my house, but how do I get to it? I'm not touching my low interest rate. We can do a line of credit, remember, to pull that equity and turn it into actionable money, right? So if you have $200,000 in equity or 100,000, we can pull out 60,000 of that, and none of those payments are going to be applied to you. So if you have let's just do the math really quick here. You do a $65,000 line of credit and it's at 10%, that's $54 a month to be able to buy a property. So for how much I spend on going to AMC theaters once a month, you'll have the money to buy a property that's paying for itself. Not only that, we talked about the payment being around what, $2,300, $2,600, and we're getting $1,200 in gross or net revenue from that. Well, that pays for the line of credit itself. So you have a renter paying for the line of credit that was used to buy the property and the property, and you're just making money. So it's really, when is our audience going to reach out to us so we can start a plan for them? So like, that's my call to action, is call us, ask questions. Let's get started.
Well, that's fantastic information, Sean, and especially with the line of credit. You just redeployed equity that was dead that is now paying you a return on just managing paper, really, and you've got two properties appreciating and you're getting cash flow. So it was a great example, and you get to keep your low rate. And the DSCR could be used, we said, anywhere from a 1 to an 8. So you could buy an inexpensive townhouse for 250,000 to make this work. You
Yeah,
could buy a
absolutely.
duplex. If you don't want to buy in the city where primarily the duplexes reside, you could buy in the suburbs and buy a townhouse or condo, utilizing DSCR. It just has to be over 150. Um, and
For the loan amount,
for the
150
loan
for the
amount.
loan amount. Yeah. So that means for the purchase price, for those that are listening, as long as the purchase price is over 187, then you'd be able to look at that.
Yeah, no, that's great. And with the rapid rescore, now, if you're just a regular homeowner, or if you know somebody that wants to be a regular homeowner, meaning just buying a house, Sean can do the rapid rescore, and that's one of the advantages of doing the counseling up front is your PMI and your rate will be determined by your credit. And if Sean can goose your credit by doing some soft pulls and some counseling, he can ultimately save you thousands of dollars over the life of that loan by getting you the better rate. So that's something essential as well. So if you're watching this or if you, like I said, have a friend or family member, Sean lends nationwide. So I work exclusively in Minnesota and in the metro area. If you need a referral outside of my service area, I can help you with that through the REMAX system. Whereas Sean actually lends nationwide. And so it doesn't matter, he doesn't have to be in your state. You could be watching this in another state and he could do your loan for you. And it doesn't matter. He has the knowledge. He's licensed in all of the states. His company, they're federally chartered and they can get it done. So uh, use him as a resource. Call him. He will get it done. Establish a friendship, a business relationship. If you're in Minnesota, I'd love it if you'd work with me. However, if you already have your preferred agent, um, you can use your preferred agent in Sean. We're a la carte. So I'd like you to use Sean. I'd like you to give him a try. I think you'd be very pleasantly surprised. He's very, as you can see, knowledgeable and efficient. So he'll help you work the numbers. He enjoys it. He's a landlord himself. So the one thing about landlording, like I'm a landlord and I have been for 39 years. Sean's been a landlord for, geez, how many, what, 8, 10 years? Um,
Uh, don't age me that much. Only about 6 years, but it's the greatest decision I've ever made, for
okay.
sure.
So he walks the walk, talks the talk, can address it. His property is right here in Minnesota, but he knows because he works all across the country. He works and knows the nuances across the country as well. So the loan product is easy. I would encourage you to look at it
And
and
just to add in on that, John,
yeah,
just really quick, because I know in Minnesota there's a lot of people that like to visit Florida, that like to take time um, out of the snowy season to go down there. We do short-term rental income calculation as well. So what that means is, and how it works is, we go to AirDNA, we look at it, and we take 80% occupancy, and we actually apply that as income. So if someone says, "Hey, well, I want to buy a property, but I want to use it part of the time," and then what do I do if to qualify? So for those people, they can call us. We do calculate income as well based upon short-term rental income.
Wow, never heard of that, Sean. So thank you for sharing that. So if I wanted to own an Airbnb, refinance an Airbnb or VRBO or whatever, there's different names for the different ones,
Mm-hmm.
own a vacation type of property, use it and rent it, I can do that with you.
Yes,
Wow. I don't know where else I can do that. I'm telling you. That's
right here. We're
we found the
here.
guy. We found the guy. Well, that's great. And then Sean, you also can do in Minnesota some of the down payment assistance programs. So that's another thing, again, if you're watching this, if you know of anybody, Sean can do the first generation program as well as other ones. And if you, we won't take up the whole video on first gen, but just know if you are a first generation homeowner, that that window is closing by probably October, and you need to get your application in. Sean can do that for you too. So he has access to first-time buyer programs, investor programs, Airbnb programs. Do you do reverse mortgages too, Sean?
Yes, yes, I did. I've done a reverse mortgage to pay off someone's debt, and they actually used that along with a DSCR loan. So they had only Social Security income, took out all of their debt, and actually bought a duplex, which is cash flowing them about $1,000 a month.
Wow, sweetness. That's awesome. Awesome. So whatever your needs are, Sean's a broker. He'll source it, he'll find it. And I would encourage you to give him a call. His information will be down below in the body of this video. And he's available to you. So thanks, Sean. Anything else you want to share with the audience? Why don't you give them your email really quick and phone number verbally over in the video, but I'll have it
Yeah, of
down.
course. My phone number is 612-816-9474. My email address is my first letter, S, and then Swanson at cmghomeloans.com. Guys, please reach out. Any questions, just get started.
Beautiful. Thank you very much, Sean.
Take
Thank you
care,
for taking
John.
the time today.